If your compensation includes company equity, there's a good chance one part of your retirement plan is riskier than you think. And it's probably not the part you'd expect. Most pre-retirees carry the same handful of fears into their final working years. Running out of money, a market crash at the worst possible time, a tax surprise, an uncovered healthcare gap, and a spouse who isn't on the same page. If your pay includes equity, now there's a variable that quietly shapes every one of those fears and almost never gets its own conversation. Whether your employer is publicly traded or privately held. In the next few minutes, I'll walk through all 5 fears and show you exactly how that one distinction changes the math on each of them. I'm Robert Boeck, founder of Retirement Roadmap Experts. I built my practice on one idea: investment management is not retirement strategy. Equity compensation is where that gap shows up hardest because a portfolio statement doesn't know the difference between liquid and illiquid. This fear gets sharper, not softer, the more that equity is involved, because equity concentrates risk instead of spreading it. At a publicly traded company, you can usually sell vested shares and diversify on a schedule. But at a privately held company, you often can't sell at all until a liquidity event actually happens, and companies are staying private far longer than they used to. SpaceX just went public this June, 24 years after founding. Airbnb waited 12. A decade ago, the median time to IPO was under 7 years, but recent data puts it closer to 11 to 14. If your retirement date is quietly depending on a liquidity event with no fixed timeline, will I run out of money doesn't have a real answer yet. It has a guess. This is sequence of returns risk. A downturn in the first few years of retirement can permanently damage a portfolio even if long-term averages are fine. Executives with concentrated employer stock face a sharper version of it. J.P. Morgan's own research on catastrophic decliners, which are public stocks that fell 70% from peak and never recovered, found that 54% of the companies were profitable at their peak. The decline wasn't predictable from the fundamentals alone. But for a privately held company, the equivalent risk doesn't show up as a falling stock price at all. It shows up as a down round or a stale 409A valuation, which is arguably more dangerous because there's no daily price to warn you that it's happening. At a public company, RSU vesting is taxed as ordinary income on the vesting date, and the shares are typically liquid enough to sell immediately to cover it, known and manageable. But at a private company, that tax bill often arrives the same way, but the shares can't be sold to pay it. This is the double trigger vesting trap. Time-based vesting plus a liquidity event trigger that hasn't fired yet. Some executives end up financing the bill with a loan against stock that they can't touch. That's not an edge case, it's structural, and it deserves its own line item in a retirement income plan. Now, this one doesn't sort by ownership structure the way the first 3 do. Benefits vary by company size and maturity more than by public versus private status. But it still deserves its own conversation because a strong equity position solves a net worth problem, not a cash flow timing problem. If you retire before 65, you need a specific strategy for the years before Medicare, and long-term care risk belongs in every plan, equity or no equity. Vesting agreements, retirement-eligible vesting provisions, and blackout window trading restrictions are frequently understood by only one spouse, usually whoever read the stock plan document. Whether shares continue vesting, accelerate, or simply stop at a chosen retirement date is often spelled out in language neither spouse has actually read together. This is not a kitchen table decision to make alone the week before a retirement date. It belongs in the room, together, well before the paperwork is due. 5 fears, 1 variable running underneath all of them. If you are an executive with equity compensation and any of those 5 fears just landed a little too close to home, this channel is built for exactly that. Every week I break down one piece of the retirement income puzzle: equity compensation, Social Security, Roth conversions, healthcare gap timing. Hit subscribe so the next one finds you. None of these 5 fears are irrational. They're the predictable result of compensation structures built for growth and retention, not necessarily for a clean transition into retirement income. A strategy built around the retirement income roadmap approach starts by identifying exactly which of these 5 is doing the most damage to your household confidence. Then build around it. A realistic liquidity timeline instead of a guess. A concentration ceiling you set on purpose instead of by accident. A tax plan for vesting events, whether or not the shares are liquid. A healthcare bridge specific to your dates. And both spouses' equity mapped onto one coordinated timeline, not 2 separate stories. So here's the part that doesn't get said enough. Almost none of this is fixed by waiting. A private company does not become liquid faster because you're closer to retirement. A concentrated position doesn't become less risky because you've been holding it longer. And a vesting agreement you haven't read doesn't get friendlier the closer you get to needing to understand it. The couples who build this plan with several years of runway have dramatically more options around diversification, around timing, around taxes, than the couples who wait until the liquidity event is already in the news. So a few fast answers to the questions that I get asked the most. Is RSU income taxed differently at a public versus private company? No. The tax rule is identical. They're taxed as ordinary income at vesting. What differs is liquidity. Public shares can usually be sold immediately to cover the bill. Private shares often cannot. What is double trigger vesting? It requires both time-based vesting and a liquidity event before shares fully vest, which is common at private companies, and it means you can be fully time vested while still unable to sell anything. Should married couples review equity plans together? Yes, absolutely, always. Vesting terms and liquidity timing directly affect household income and can involve decisions that are difficult to reverse. So, running out of money, a bad timing market crash, a tax surprise, a healthcare gap, and a spouse who isn't in the loop. 5 fears, and public versus private equity structure changes the math on 4 of them directly. If that's where you are right now, I'm going to invite you to a retirement clarity call. 30 minutes, no products, no pitch, and no pressure. Just an honest look at how your equity fits your specific timeline. The link's in the description and the pinned comment.